All right, let's get straight into it. No preamble. It is Sunday morning, and our only job right now is to reset the deck for tomorrow's open.
Let's do it.
So, zooming out to the weekly time frame, what do we get? The S&P 500, it did manage to close last week with a small-bodied bullish reversal.
It did, which sounds constructive on the surface.
Right, sounds constructive, but the index still finished the week down. We're talking negative 0.76%. So it was really just consolidating near those record highs, but you could feel the struggle underneath.
That negative 0.76% is the perfect camouflage, really. It hides the pressure that's building, and you absolutely have to look at fixed income here. The bond market is basically screaming a warning at us.
Okay, so what's the warning?
The U.S. 10-year yield. It just kept marching higher, added another 5 basis points last week, and it's now sitting at 4.19%.
419. Why is that specific number so toxic right now? I mean, we've seen rates higher than this over the past year.
Because of the timing. It speaks directly to this idea of persistent inflation, of growth that just won't roll over. And what that means is the Fed's long-awaited dovish pivot. Well, it's just receding further and further into the distance.
So for active traders, that changes the math completely.
It completely changes the math. Higher long-term rates mean a higher discount rate on future earnings. So who gets hit the hardest?
The darlings. Long-duration assets. All the tech and growth stocks that are priced for perfection years from now, not on today's cash flow.
Exactly. The bond market is stubbornly, and I mean stubbornly, refusing to buy into the high equity valuations that this whole AI narrative has built.
Okay, that makes sense. So let's unpack this technical landscape then. Because the price action, it's stalled out right where it mattered most. We really do have to reset the deck here after hitting that major resistance.
We have absolutely met our ceiling, and you have to respect the architecture of the chart here.
The S&P 500 ran smack into a formidable wall. I'm talking a clear descending trend line.
And let's give some context on that line.
Yeah, this isn't just some day trade level. This is the 9-month trend line going all the way back to the Q1 highs. That is institutional grade resistance.
It is.
But our models are flagging some mixed signals. We did see institutional accumulation patterns in the SPY volume profile, specifically a lot of volume clustered right around 4.065 million.
Okay, that accumulation figure is interesting, but we have to put it in context. That STY volume, you have to weigh it against the entire market, where conviction is just draining away. Trading volumes across the board are down a staggering 15% from November.
15%. That's a huge drop.
It's a massive drop, and that tells you we're dealing with exhausted buyers. There's a serious lack of conviction for any kind of sustained breakout. So when institutional money dries up, that accumulation you saw, it starts to look less like strategic positioning and more like, tactical short covering.
Yeah.
Especially as we creep up to that huge S&P 500 resistance at 6,850.
Okay, sticking with the SPX, let's establish the key price level for the week. The line in the sand is 6521.92. Why is that number the one everyone needs to have on their screen?
Because that's the level that confirms structural weakness. It's that simple. If we get a sustained break below 6521.92, that would immediately confirm bearish momentum. It validates a potential double top on the charts.
Which means the recent peak was just an exhaustion move.
Exactly. Not a consolidation. Now, on the flip side, to feel safe, to know this pullback is over, we need to see a decisive move through 6,834. Anything in between is just noise and high risk.
And if that weakness gets confirmed, the most vulnerable spot has to be the Nasdaq, which has been the engine of this whole rally.
Oh, without a doubt. The Nasdaq 100, the NDX, it showed a really mixed and, frankly, pretty worrying picture last week.
We've been talking about that decisive break of its long-standing support trend line for a while now.
And for anyone prepping for tomorrow, that break signaled institutional distribution. So let's be clear about what that means.
Yeah, what does that mean practically?
It's not just retail traders getting nervous. This is the big money. The large pools of capital actively de-risking their portfolios because they see a potential downturn or a major rotation coming.
Right.
So while the NDX is still technically above a rising medium-term trend line, that underlying structure is getting really fragile. The zone you must watch, the absolute line in the sand for the NDX, is 23,000 down to 22,900.
And if we lose that?
If we lose that zone, it instantly invalidates the whole constructive bullish bias. That's the trapdoor. That's where you'd expect to see downside start to accelerate. The real pivot for upside is much, much higher. around 25,331. The big money is just telling us to be cautious here.
Okay, that covers the technical debt we're carrying into the week. Let's shift gears. What's the biggest macro theme as we head into the holidays? I think we all know it. It's the year-end positioning and the much-hyped Santa Claus rally.
This is the seasonal dynamic that just overlays everything else we've talked about.
Yeah.
And it's so important to understand the mechanics here. Trading desks are closing up shop, people are on vacation, and liquidity just evaporates.
It gets thin, really thin.
Right. And this low-volume environment is incredibly unpredictable. A small buy or sell order that would normally be absorbed can create these outsized price swings.
So you have two forces really battling it out. On one side, you've got performance chasing. Portfolio managers trying to juice their returns for their year-end statements, which could drive that late-year surge.
That's the classic Santa Claus rally thesis. But the flip side is just brutal, sharp chop. Low liquidity is a volatility amplifier. You can see these huge moves on almost no news, which makes for really treacherous trading conditions.
So history might say the rally is real, but getting there can be painful.
Exactly. The volatility leading into it, especially this last full week in December, can be brutal. You have to assume every move is going to be amplified by this holiday thinness.
And the seasonal weirdness is colliding with a pretty severe economic disconnect, right? We have this incredible AI-fueled equities rally, but the consumer, who's supposed to be the bedrock of the economy, is flashing some serious warning signs.
The divergence is staggering. I mean, you have Wall Street partying, and Main Street is getting worried. The University of Michigan Sentiment Index just got revised lower. People are concerned about their finances. And here's the statistical bombshell.
What is it?
A hefty 63% of consumers still see rising unemployment on the horizon.
Okay, so how do we reconcile that as traders? You've got this AI rally, but then you have 63% of people expecting to lose jobs. Are those two things just on completely different timelines?
They're looking at completely different people, and that is the key insight. The AI rally is driven by massive concentrated flows into just a handful of mega-cap tech names. It's benefiting institutional capital, the top 1%. Meanwhile, the consumer data reflects the reality for everybody else who's dealing with sticky inflation, higher mortgage rates, and real job insecurity. The rally is incredibly narrow, the pessimism is incredibly broad.
And when a market is that narrow,
it's strategically vulnerable. Any piece of bad news that hits one of those few leaders can bring the whole index down.
And to add another layer of confusion, we're still dealing with delayed commitment of traders data, the COT data, but we are getting some clarity in commodities, and it just adds to this picture of divergence.
The commodity picture is fascinating because it shows nobody at the institutional level agrees on where the global economy is headed. You have CTAs, the big trend-following funds, heavily net negative in crude oil.
So they're betting on weakening global demand.
Right, which ties right into that pessimistic consumer outlook.
Yeah.
But at the same time, speculators are net long corn for the first time in 6 months. They're betting on higher food prices.
What does that tell you?
It tells you conviction is low across the board. Institutional money isn't moving together. It's a market that is actively picking very specific winners and hedging against major risks everywhere else.
That sounds like a recipe for volatility. Let's pivot to the calendar then. The red folder events that carry the most binary risk this week. And given how thin the market is, Tuesday is really the focal point.
Yeah, you have to remember the rule here. Low volume amplifies impact. A piece of news that might cause a 50-point S&P move in July could easily give us a 150-point swing this week.
Okay, so tomorrow, Monday, December 22nd, we get the PBoC interest rate decision out of China.
The so what on this is enormous. China's policy decision is a direct signal on global growth. If the PBoC delivers a surprise rate cut, they're trying to stimulate their economy. That could give a temporary lift to global equities.
Especially emerging markets, commodities, global industrials.
All the things that feed off Chinese demand. But if they hold rates steady despite all the weak data we've been seeing, that just reinforces fears of a global slowdown.
Then we get to Tuesday, December 23rd. This is the big one. US Q3 final GDP and, more importantly, the Core PCE price index.
The Core PCE. This is the Fed's preferred inflation gauge, and for a good reason. It strips out the noisy food and energy numbers, so it gives you a much cleaner read on underlying inflation.
So let's nail down the binary risk. What does a hot number do to a portfolio?
If GDP gets revised up, or critically, if Core PCE comes in hotter than expected, it just pours gasoline on that rate hike fear narrative.
Right.
Persistent inflation, stronger growth. That pressures valuations everywhere, but especially in tech and growth. Their whole model is based on cheap money and future earnings. A hot PCE reading could trigger a sudden, brutal re-rating of those names.
Also on Tuesday, we get the U.S. Consumer Confidence Index.
And this is the direct measure of that pullback we were just talking about. This has a direct link to consumer discretionary stocks. If that number is weak, if it reflects that 63% unemployment fear, it means consumers are shutting their wallets.
And that hits retailers hard.
Right when they need it the least. You should be looking at short-term vulnerability in those names heading into the final holiday sales numbers.
And finally, there's a classic ripple effect risk on Thursday, December 25th. U.S. markets are closed for Christmas, but we get key inflation data out of Japan, their CPI.
This is a huge one for financials. Hotter Japanese inflation pressures the Bank of Japan to finally move away from their ultra-loose monetary policy.
Yield curve control.
Exactly. And if the BOJ is forced to tighten, you risk a massive carry trade unwind.
Okay, define that risk for someone getting their positions ready.
The carry trade is simple. For decades, investors have borrowed Japanese yen for next to nothing and used that free money to buy higher-yielding assets all over the world. If Japan's rates normalize, the cost of borrowing that yen skyrockets.
So everyone rushes for the exits at once.
A sudden rush to unwind those trades. That means capital gets pulled back from global markets, hitting currencies and financials. It's a major overnight risk you need to be aware of, even if your desk is closed.
Okay, with the calendar set, let's define the game plan. What is the single biggest pain trade for portfolios that are positioned aggressively into year-end?
The biggest pain trade, bar none, is a rotation out of those concentrated U.S. tech and AI winners. The market is historically narrow. A massive amount of the S&P's performance is tied to a tiny number of stocks.
And in a thin market.
Thin trading will just amplify any reversal. If those mega-cap names that drove the rally suddenly take a breather, whether from profit-taking or valuation worries, the whole index suffers. It will cause significant pain for anyone just riding that linear momentum.
But the flip side, and this is maybe the good news, is that the broader market isn't universally overbought. There are opportunities outside that crowded tech trade.
That's the nuance you have to grasp.
Yeah,
tech had a big bounce, but only 56% of S&P 500 stocks are actually trading above their 50-day moving average.
which is not an overheated reading.
Not at all. It's a healthy intermediate reading. It tells you there are strategic opportunities out there if you're willing to look beyond the big, obvious names.
So which sectors should a disciplined trader be looking at for potential year-end positioning?
You should be focused on areas where value still exists. Small caps, for instance, are still looking undervalued by about 15% to their fair value.
Okay.
And beyond that, you've got sectors like utilities, bonds, emerging markets, energy, real estate. They're all still trading at oversold levels compared to their historical averages. If that rotation out of tech happens, that pain trade we talked about, these are the areas that stand to benefit.
All right, final instruction on levels. We have to watch that S&P 500 6,850 resistance. The big vulnerability here is complacency.
That is the ultimate line in the sand. A failure to clear 6,850 decisively, especially on the shrinking volume we're seeing, that's a massive red flag. The market structure is telling you to stick to these pivots ruthlessly.
Because in this environment.
Complacency in this low-volume, high-skew environment could be extremely costly. The smart money is already hedging. The high cost of protection against the downside proves that institutions are expecting chop. So be nimble, stick to the pivots, and assume every single move is going to be amplified by this holiday thinness.
Prepare for the volatility. Stick to the data. We'll see you tomorrow morning for the open.